everybody. Luke Gromen, FFTT. Hope everybody had a great weekend. I will say it was probably one of the nicest weekends of the year here in Cleveland. Just absolutely perfect weather. And to boot, my Cleveland Browns won today, making them 2-1, which means they are above 500 for the first time in 84 games. So if we're looking for signs of the apocalypse or something big happening, maybe we could start there. So at any rate, just got back a little bit ago from throwing batting practice to my son. So I'm good and loosened up, ready to go here tonight. So let's jump right in. First question, how likely are we to see an increase in monetary velocity sufficient enough to cause a meaningful jump in inflation? What would cause that increase, and when would you expect it, considering unemployment is still near the '08 peak and bankruptcies are at a 10-year high? To me, it depends heavily, if not entirely, on what the fiscal side, in other words, what the government spends in deficits, in conjunction with the monetary side, what the Fed does. When we saw the U.S. government deficit spend and basically hand money out from, call it April through July, and the Fed effectively monetized most or all of that, we saw inflation. We did. And so I think the important thing here to understand as it relates to this ongoing inflation discussion is it's almost entirely a political decision. It's subject to U.S. political processes, but given U.S. fiscal situation, in my opinion, we'll see more aggressive fiscal spending post-election. Now, when I say it's almost exclusively a fiscal decision, a political process, what do I mean? Let's take an extreme example. In theory, if we can get through the political side of it, let's pretend I hand out $1 trillion a week for the next 52 weeks, or $2 trillion a week. Let's say we hand out $2 trillion a week for the next 52 weeks. So the government is going to run $2 trillion deficits per week for the next 52 weeks. There's going to be $104 trillion injected into the economy over the next 52 weeks. I assure you we would see inflation. The dollar wouldn't like it much, but we would see inflation. And this, to me, I think is an important point that a lot of people are missing. They're looking for inflation solely from monetary velocity, from bank lending. But you can have inflation come from currency depreciation without bank lending. We saw that in the 70s. It was called stagflation. The dollar falls enough, and it's given that we import as much as we do, we would start to see inflation. So ultimately, crisis or not, in my opinion, if we have a crisis or not first, that we need to get this type of spending post-election, that to me is the key question at this point, is what I was trying to say. I'm not sure the crisis needed to spur this type of post-election spending is as big as a lot of people think, though. So let's jump into the next question here. Opinions on markets and gold and how it plays out into the election. Is there a potential deflationary bust across all assets with a Biden win with the hike in capital gains tax rates? In my opinion, it depends, on the fiscal side here. Do we get fiscal spending and stimulus before the election, or do we not? If we don't, then I think we probably get a risk off. If we do, then I think you want to own stocks and gold. I'm not sure who wins or loses matters as much as many people think. COVID's pushed the U.S. into an acute fiscal crisis that really started a year ago with the repo rate spike. That was when the U.S. fiscal crisis went acute, and I think it became largely irrecoverable without MMT-like policies once COVID hit. So I don't think the U.S. government has nearly enough operating room to actually have a lot of difference between Republicans and Democrats in this election. I know there's people talking about the capital gains tax hikes from Biden. I don't think that would be positive for stocks. I think it could cause a risk off if he wins and sticks by his guns during the lame duck period before he's in office. But ultimately, I would see that as a buying opportunity, because I think he's going to get in office and they're going to sit him down, run through the numbers, and he's going to quickly realize that I think a capital gains tax that caused stocks to fall would actually lead to a lowering of tax receipts, not an increase. Capital gains and asset price appreciation are so critical to driving U.S. GDP, U.S. consumer spending, that if stocks fell as a result of a capital gains tax, you would likely actually see a decline in overall tax receipts, not an increase with a capital gains tax increase. So I don't think ultimately if Biden gets in, I don't think he's going to implement that. Next question. In light of recent events, has the market properly priced in geopolitical risk, as in Dmitry Kofinas? We may be at greater risk of annihilation today. Like the period pre-1914, the Western world has become accustomed to peace and prosperity. Complacency combined with a revolution in technology of war making has laid the groundwork for the most destructive war in human history. I agree the market's not pricing in geopolitical risk. I think that is partly because of a pre-1914-like attitude that the world is too interconnected to allow this to happen. And so I do think that tail risk assets or assets that would do well, it's just further fuel. You need some gold, you need some Bitcoin, you need some cash in your portfolio. However, I don't think a global war is likely either. And the reason I think that is because the vulnerabilities of both China and the United States are so great and so immediate that were a conflict to break out like that, I think it would quickly go nuclear. And by that, I mean the vulnerabilities. The U.S. would shut off China's food and oil supply. The Chinese would shut off the U.S.'s antibiotics and drug supply. And you'd have tens of millions in each side dying probably within the first several months. And so both sides will be desperate enough, it'll go nuclear, in my view. And as a result, I just don't think it's very much of an investable scenario. And so I do think you can see headlines geopolitical risk. I just don't think another world war, as it were, World War I, World War II, is very likely. So let's see here. Lastly here, in short-term expectations on the dollar and the corollary, your short-term expectations on gold and silver. Are you a short-term dollar bull? I guess. The reason I say that is look, it's just a recognition of the machinery that's at work. The U.S. fiscal crisis has gone acute, as we just described, as a result of COVID. And so either the U.S. fiscal stimulus and the Fed monetizes enough of it, or they don't. And if they don't, the dollar's likely to remain bid, as we've seen over the last 2 to 3 weeks in particular. Ultimately, the dollar can't rise very far without breaking markets up to and including the Treasury market, and the United States is not going to let the Treasury market break, full stop. We saw that in March when the Fed said that the Treasury market effectively ceased functioning, and we got $600 billion a week in QE. So, and the dollar went from 102 to 92 in 4 months. And so that's what I mean by they're not going to let that happen. And so, ultimately, have I sold any gold? No. Have I sold any Bitcoin? No. I'm still buying gold and Bitcoin. They're still my two favorite assets, even though I'm cognizant that in the short run, the dollar technically looks good. Gold and Bitcoin look like they're a little bit soft technically. Ultimately, I think the big takeaway, and I'll leave you with this for tonight, is we are living through the bursting of the first global sovereign debt bubble in 100 years. We are living through the first changeover of a currency system in at least 50 years, going back to 1971. These types of things are very difficult to trade, and they're very difficult to trade on leverage. Dan Oliver had a great chart earlier this year, my friend at Mermacan Capital, and what he highlighted was that from 1914 to 1923 in the Weimar Republic, the price of gold basically went to infinity. And so the trade looks like borrow as much as you can, buy gold, and then the gold rises and pays off your debt. Problem is the volatility was so great that you lost all your money 4 or 5 different times before gold went to infinity in Weimar mark terms. And so my point here is that I think you want to be unlevered, and I think you want to be very careful about trying to trade the bursting of the first global sovereign debt bubble in 100 years and the first currency system change in 50 years. It's likely to be extremely difficult to do so. I think you want to own the assets that are likely to win. I think we've spent 50 years being asked, what's the most levered way to play this? Given the bursting of the sovereign debt bubble and the change over the system, I think the question is no longer what's the most levered way to play this. I think the question is becoming what's the best unlevered way to play this. And to me, that remains gold, Bitcoin, silver. And so I will finish with that. As always, check out FFTT-LLC.com for more information about what we're up to. And if you like these updates, you can also find out more information about FFTT tree rings there. 10 most interesting things, synopsis. We get great feedback on it, and comes out every Friday afternoon. I think you'd really like it, so check that out. Otherwise, everybody have a great week. Stay safe out there, and we will talk with you all soon.